Right now, SoFi Technologies, ticker symbol SoFi, is trading at $28.02, down 12 cents on the day, or about 0.43%. Now, seeing a minor dip like this might not seem like much, but what many investors are missing is the subtle but critical tug-of-war happening just beneath the surface of these daily fluctuations. The common belief, the story that has propelled SoFi to this valuation, is that it's a fintech disruptor, a sleek, modern alternative to clunky old banks. Investors using platforms from Robinhood to SoFi's own SoFi Invest bought into the idea of a one-stop shop for finance that would grow at a blistering tech-like pace. But the reality is far more complex and, frankly, more interesting. SoFi is quietly completing a transformation not into a neobank, but into a fully chartered FDIC-insured national bank that just happens to have a great user interface. This isn't just a semantic difference. It fundamentally changes the entire investment thesis, the risk profile, and how we should value this company going forward. The market still seems to be pricing it with the high-flying expectations of a software company, but its destiny is now intertwined with the gritty, capital-intensive, and cyclical world of traditional banking. The real question is whether its tech advantage can produce banking profits that justify a tech multiple. Let's break down the recent price action. This minor pullback today isn't happening in a vacuum. Over the past several weeks, we've seen significant volatility in the stock, with trading volumes that suggest a real battle between institutional bulls and bears. On high-volume days, you can see large block trades being executed, the kind of activity typical of accounts managed through services like Fidelity Wealth Management, or traded on sophisticated platforms like Interactive Brokers. This isn't just retail enthusiasm anymore. The big players are making their moves. The stock's reaction to the last earnings report was a perfect example of this tension. On the surface, the numbers were strong. Another quarter of record revenue, impressive member growth exceeding projections, and a significant beat on adjusted EBITDA. Management painted a rosy picture of accelerating cross-buying, with members using multiple products, which is the core of their strategy. The market initially popped on the news, as the headline numbers confirmed the growth narrative. However, the stock gave back some of those gains in the subsequent days as analysts and institutional investors scrutinized the details. Specifically, the focus shifted to the net interest margin, NIM. With the bank charter, SoFi can use its own member deposits to fund its loans, which is a much cheaper source of capital than what it relied on previously. The expectation was for a dramatic expansion in NIM. The reality was a solid improvement, but perhaps not the explosive jump some had priced in. Furthermore, the guidance, while strong, contained undertones of caution regarding the macroeconomic environment. This is where the story collides with the spreadsheet. The story is about disruption. The spreadsheet is about credit quality, loan origination volumes in a potential recession, and the fierce competition for deposits. The performance of SoFi's three distinct segments tell the whole story. The lending division, which includes student loans, personal loans, and home loans, remains the primary revenue and profit driver. The end of the student loan moratorium was supposed to be a massive tailwind, and while it has certainly boosted origination, the competitive landscape for refinancing is intense. Competitors from traditional banks to other specialized lenders are all fighting for the same high-quality borrowers. The reality is that this is a cyclical business. If the economy slows, demand for personal loans could soften, and more importantly, default rates could tick up. SoFi's management insists their underwriting is disciplined, targeting high-income earners, but no lender is completely immune to a broad economic downturn. This is a risk that many retail investors, excited by the app's user experience on platforms like Robinhood or when doing some self-investing, might be underestimating. Then you have the financial segment. This includes SoFi Invest, SoFi Money, their checking and savings, SoFi Credit Card, and other services. This is the flywheel, or the engagement loop you hear so much about. The goal here isn't necessarily massive direct profitability yet, it's about acquiring and retaining members within the SoFi ecosystem, making them stickier and increasing their lifetime value. The expectation is that this segment will eventually become a major profit center. The reality is that it's a very expensive, high-burn part of the business right now. They offer a very attractive high-yield savings account to attract deposits, which is great for consumers but compresses their margins. They're spending heavily on marketing to promote these products. While member growth is impressive, the key metric to watch is the monetization of these users over time. Are they successfully converting a free checking account user into a high-margin personal loan customer? The data suggests they are, but the pace and efficiency of this conversion will determine the long-term success of the entire model. This is where the battle against incumbents is fiercest. Everyone from Chase to Fidelity, with its extensive ecosystem of Fidelity ETFs, Fidelity mutual funds, and a robust Fidelity mobile app, is a competitor. Even automated online investment platforms like Schwab Intelligent Portfolios compete for the same investor assets that SoFi wants to attract through SoFi Invest. The third piece of the puzzle, and arguably the one that fuels the tech company valuation argument, is the technology platform segment, which consists of Galileo and, more recently, Technisys. Galileo provides the back-end infrastructure for many other fintech companies, allowing them to issue cards and manage accounts. The expectation is that this is a high-margin, sticky software-as-a-service business that can grow independently of SoFi's consumer operations. The reality has been a bit choppy. Growth in this segment has slowed from its peak, and its performance is tied to the health of its underlying fintech clients, some of whom are struggling in the current economic climate. The acquisition of Technisys, a cloud-native banking core platform, is meant to supercharge this segment, allowing SoFi to offer a complete end-to-end solution for any company wanting to offer financial products. This is a powerful long-term vision. The reality is that integrating a massive acquisition like this is complex and expensive, and the sales cycles for core banking technology are notoriously long. The market is waiting for tangible proof that this integrated offering can win major clients and re-accelerate growth. If it can, it provides a powerful justification for a higher multiple. If it sputters, the bull case for SoFi as more than just a bank takes a significant hit. Let's pause here for a moment. I want you to comment below. Based on this structure, do you think SoFi deserves to be valued as a tech company or as a bank? There is a huge difference in the potential valuation, and I'm curious to see where the sentiment is. Now, let's step back and look at what SoFi actually is. Founded in 2011, its initial focus on refinancing student loans for alumni of top universities, a niche of high-quality, low-risk borrowers. This was their wedge into the market. From there, they methodically expanded their product suite to include personal loans, mortgages, and eventually the full array of financial services we see today. The move to go public via a SPAC in 2021 was timed with peak market enthusiasm for high-growth tech stories. The acquisition of the bank charter in 2022 was the most significant event in the company's history. It was the moment the expectation of being a nimble fintech officially merged with the reality of being a regulated depository institution. This charter gives them a massive strategic advantage, the ability to use low-cost customer deposits to fund their loans, rather than relying on more expensive wholesale funding markets. This directly impacts their profitability and their ability to offer competitive rates. However, it also brings them under the strict oversight of regulators like the Office of the Comptroller of the Currency. They now have to deal with capital requirements, stress tests, and the intense regulatory scrutiny that comes with being a bank. This is a double-edged sword that the market is still trying to properly price. It provides a moat and a path to higher profits, but it also introduces a new set of risks and limitations on how they can operate. Looking forward, the future outlook for SoFi stock hinges on a few key factors. The bull case scenario is that the flywheel strategy works exactly as planned. Member growth continues at a rapid clip, driven by best-in-class products and a superior user experience. More importantly, the rate of product adoption per member accelerates, driving that all-important lifetime value higher. Under this scenario, the bank charter allows them to significantly expand their net interest margin, driving the lending business to new heights of profitability. Simultaneously, the technology platform, powered by the combined forces of Galileo and Technisys, lands several major clients, reestablishes itself as a high-growth software business,